You've got $100,000. That's a solid number, not rich, but enough to change where you end up. So here's the question. What if you invest it in Vanguard index funds? That's exactly what John is about to do. Same money, 5 different index funds. And depending on which one John picks, he either builds a fortune or leaves more than $12 million of it on the table. In this video, John's walking through exactly what $100,000 can do inside the top 5 Vanguard index funds, ranked from number 5 all the way up to number 1 based on total value added. One of these funds pays him the most every month, and it's not the one anyone would bet on. By the end, I'll show you which Vanguard fund turns John's $100,000 into almost $15 million. Now, before John picks a single fund, here's the one thing that decides this whole video. Money in an index fund grows 2 different ways. First, the share price goes up. That's the big one, and it's the one everyone watches. Second, dividends. Actual cash the fund pays you a few times a year just for holding it. Most people forget that part even exists. Now, every fund on this list grows John's money. That's not the question. Some of them grow it a little, one of them grows it into a genuine fortune, and the gap between the smallest and the biggest is more than $12 million off the exact same $100,000. That's the real story here. Which fund and how far apart they actually land. So let's start at number 5. If you want income, you buy the income fund, right? The name's right there. Vanguard High Dividend Yield. It does pretty much exactly what it says. This fund owns close to 600 companies, and they're the names you already know. The old, steady, boring giants that have been around forever and pay their shareholders like clockwork. Your JP Morgans, your Johnson & Johnsons, ExxonMobil. Companies that aren't going to double overnight, but companies that aren't going anywhere either. It even leaves real estate stocks out on purpose to keep the focus on dependable payers. And because it's stuffed with these mature names, it barely flinches when the market gets choppy. It moves a lot less than the average fund. So here's the first number that actually matters. Dividend yield. That's just how much cash a fund pays you each year compared to what you put in. This one yields about 2.37% on John's $100,000. That's roughly $2,370 in his first year just for owning it. The highest starting payout of any fund in this video. And it's cheap to hold. The expense ratio, that's the fee Vanguard charges to run the thing, is 0.08%. 8 cents a year for every $100. Here's where the share price comes in. This fund climbs about 9% a year on average. Not explosive, but steady. Now, if you're wondering where all this is coming from, the holdings, the yields, the growth rates, it's all from today's sponsor, Seeking Alpha. And that's just the start of what they do. They've got a stock and ETF screener that finds picks based on exactly what you're after. And their alpha picks? Those have beaten the S&P 500 by over 320%. They've also got a top stocks report for the second half of 2026, which goes live July 14th. There's quant-backed picks built around growth and long-term performance, which is their flagship for stock picking, and it's exclusive only to Seeking Alpha members. If you want in on that, their links are down in the description or pinned comment, and you'll get the best discount out there, 10% off premium. If you want their stock picks as well, the Alpha picks and bundle links are right there next to it. All right, let's see how John's $100,000 is projected to grow in VHYAX. After the first year, he's sitting around $111,000. 10 years in, it's up to roughly $282,000. By year 20, it's pushing $744,000. And by the time 30 years are up, that original $100,000 is projected to land just under $1.9 million. Most of that, call it $1.6 million, comes from the share price slowly climbing along the way. The rest, about $157,000, is just dividends piling back in year after year, building on themselves. And by that final year, the fund is projected to pay him $9,476 for the year, or around $790 a month. That's a couple of utility bills and a tank of gas covered just for holding the fund. Hold on to that $790 number. It's going to look very strange by the time we reach the top. Because here's the trade that John is making. The fund pays the most up front, right from day one, yet it finishes with the smallest pile of all five. Seriously, almost $1.9 million is a lot of money, but it lands dead last in this group. The income fund does its job. It pays. It just doesn't grow as much as the others. Number 4 is the middle of the market, literally. Everybody knows the giant companies, Apple, Microsoft, the trillion-dollar names, and everybody's heard of the tiny startups, the lottery ticket stocks. The Vanguard Mid-Cap Fund owns the layer in between. Companies that have already made it, real businesses, real revenue, they're just not household names yet. Stocks like Seagate, Vertiv, Howmet Aerospace, Cummins. This one's the opposite of a fund riding on a few big bets. It holds around 300 companies. No single name is carrying a huge percentage. If one of the stocks has a bad year, the fund doesn't come down with it. Over really long stretches, these middle companies have actually beaten both the giants and the small fries. And they've got room to grow. And they're sturdier than the little guys. They've cooled off lately while big tech ran the show, but over 30-year windows, the middle has a real track record. So what does the middle do with John's $100,000? Well, it climbs about 10.7% a year, barely faster than the income fund, about 1.5 points. Doesn't sound like much, but watch what it does anyway. First year, John's $100,000 is projected to be around $112,000. 10 years in, past $307,000, already pulling ahead. By year 20, around $922,000. And 30 years out, it's projected to reach about $2.72 million. That's over $800,000 more than the income fund's ending number, from 1.5 points of extra growth a year. That's compounding for you. But the real shock is the income. Watch this. Remember, the income fund pays John $790 a month at the end. This one, the mid-cap fund nobody thinks of as an income play, pays him $16,648 a year, or $1,387 each month, nearly double. So how does that happen? Well, it comes down to a second number no one really bothers to check: the dividend growth rate. See, the yield tells you what a fund pays you today. Meanwhile, the growth rate tells you how fast that payment climbs every single year. And that is where these two funds completely split. The income fund grows its dividend by about 4% a year. The mid-cap fund grows by close to 8%, twice as fast. And over time, that's everything. A smaller check that grows fast and runs right past a bigger check that sits still. The income fund starts out ahead, but certainly doesn't end that way. Okay, we're only 2 funds in, 3 to go, every one of them bigger than this. And in the end, I'll show you a fund that turns John's $100,000 into almost $15 million. For now, climb one more stair to number 3, where we find the one fund on this list you almost definitely heard of and probably already own. It takes that mid-cap result and basically doubles it. The Vanguard 500 Index Fund. You know this one. It tracks the S&P 500, which is just the 500 biggest companies in America all bundled into a single fund. When people say, just buy an index fund and chill, this is usually the one they mean. You're buying a slice of basically every major American company all at once. Nvidia, Microsoft, Apple, Amazon, all of it, around 500 names. And the giants at the top do most of the heavy lifting. It's also the cheapest fund in this entire video to hold. The fee is 0.04%, 4 cents a year per $100. You're paying almost nothing to own a piece of 500 of the biggest companies in America. So John's $100,000 goes into the S&P 500, and this fund climbs about 14% a year over the long haul. That's the number the S&P is famous for. Put John's $100,000 through those numbers, and here's the path. First year, he's at about $115,000. 10 years in, it's grown to roughly $393,000. By year 20, around $1.49 million. And 30 years out, it's projected to reach $5.56 million. That's just over double what the mid-cap reaches. Same $100,000, same 30 years, just a wider slice of the market, and the pile doubles. Break that final number down, and about $5.39 million of it comes straight from the share price climbing. Only about $70,000 is reinvested dividends, barely anything next to the income fund's $157,000 because the S&P just doesn't pay much. Here, the growth does basically all of it. Because here's the catch with owning all 500 of the biggest companies. A lot of them are barely growing anymore. They're huge, they're safe, and they're kind of stuck. So, what if you just threw those out? Keep the fast half, dump the rest. Well, that's number 2. And basically, the Vanguard Growth Fund does exactly that. It takes the S&P 500, keeps the fastest growing companies, and drops the slow ones. So instead of 500 names, you get around 158. The fund gets narrower on purpose, and it leans hard into the winners. The top 10 holdings alone are more than 60% of the whole thing. Nvidia, Apple, Microsoft, the growth monsters. When they run, this fund runs. That concentration is the entire point. Fewer companies, bigger bets, way more of John's money riding on the names at the top. It's the plain S&P pushed harder. More upside, more risk, same basic idea with the volume turned up. Now, here's why a growth fund barely pays you anything. These companies don't hand out big dividends. They take their profits and pour them right back into growth, building, hiring, expanding. So you get almost no income out of them. You'll see that in a second. But before those numbers land, one honest caveat here. This fund has actually grown around 17% a year lately. Huge number. And it's not the number going into John's projection. Here's the reasoning. Growth stocks just ran one of the hottest decades in market history. Assuming 17% holds for 30 straight years means assuming the best run ever just keeps going forever. And that's a huge assumption. So the projection number we're going to use gets a haircut. Down to 15%. Still a fantastic return, just a more honest one. So with that 15% baked in, here's what John's $100,000 looks like. First year, it's projected to be around $115,000. Nothing dramatic yet. 10 years in, roughly $413,000. By year 20, it's already pushing $1.68 million, and now it's really moving. 30 years out, it's projected to reach $6.81 million. $6,811,150. That's another $1.3 million on top of the S&P, even after cutting the growth rate down. And the income? Well, this is the brutal part. At the end, this $6.8 million fund pays John about $52 a month. $52 on nearly $7 million. The mid-cap, which lands at less than half this size, pays $1,387. So the paycheck keeps shrinking as the pile explodes. But wait, it's about to get even more extreme. Here's the thing about this growth fund. It's already mostly tech, but watered down. It's still holding Amazon, Tesla, Eli Lilly, companies that technically aren't tech at all. So what happens if you strip away every one of those and keep only the pure technology? Just the chips, the software, the hardware. Well, that's number 1 on our list, and it's the most extreme fund in this whole video. The Vanguard Information Technology Fund is where things get a little crazy. Remember how the growth fund was watered down with Amazon and Tesla and a handful of non-tech names? This fund cuts all of it. It keeps only pure technology, the chip makers, the software companies, the hardware giants, and nothing else. No retail, no car makers, no drug companies, just tech, concentrated down to its core. And the growth here is honestly almost hard to believe. This fund has actually run close to 25% on average each year over the last decade. So, for more realistic projections, that number gets an even bigger haircut than the last one, for the same reason, dialed up. Nothing compounds at 25% a year for 30 years straight. The bigger the run, the harder the eventual come down. So John's projection uses 18% instead of 25%. And let's look at those projections. John's $100,000 in this fund is projected to reach $118,000 by the end of year 1. By year 10, $533,000. By year 20, it's already at $2.8 million. Then in that final decade, the compounding goes vertical, and it rockets from $2.8 million to $14.7 million. The last 10 years do more than the first 20 combined because of compounding. The biggest pile by a mile, nearly $15 million, more than double the next closest fund. Now, I dare you not to laugh. Check what it pays him. $90 a month. That's it, $90 on almost $15 million. The fund that builds John more money than anything else on this list by millions hands him almost nothing. $90 a month. That's the deal with the tech fund. Monster growth, almost zero income. Plus, it's the wildest ride on the list. Now, what if you want income along with growth? Click the video on the screen and I'll show you the REITs that are projected to turn $100,000 into a $6 million portfolio that pays over $11,000 a month.